I missed this lift. What do I do now? Come on, that's the number one question.
Well, I think if you're trying to be invested in equities now, you need to be defensive in terms of how your portfolio is positioned.
All the easy money got made.
I think so. We've had a very aggressive rally against what has actually been deteriorating fundamentals. The economic data has been surprising on the downside, and we've seen downgrades come through to US earnings forecasts. So sentiment has improved around trade. The Fed has helped equity markets with a more dovish tone, but the actual fundamentals have been deteriorating.
To what we've seen and what I've seen written about, though, the wall, forget about wall of worry, the wall of December is tangible. And we had one hedge fund guy, prime broker guy, last week who just simply said nobody participated. Hedge funds didn't participate in the leap up. What does it signal to you that it was the quintessential wall of worry?
Yeah, I think that there is an issue that people haven't participated in the rally, and I think certainly if the S&P consolidates above 2,800, the more time we spend in that level with lower volatility, the more people are likely to be sucked back into that market. But as I said, given the fundamentals have been deteriorating as the market's had such an aggressive rally, we'd certainly be cautious about putting new money to work at these levels.
Greg, have they been deteriorating to the point where we could foresee a recession in 2020, 2021 in the US?
There's certainly risk that we could see a recession, but I think importantly for equity markets, you don't necessarily need to see a recession to see equity markets trade lower from here. The S&P is now trading on an above average earnings multiple for earnings growth that's relatively low, certainly relative to the history that we've seen recently. And I think some of the quality of that earnings growth is pretty poor as well. So I don't think we necessarily even need to see a recession. Even if the fears of a recession grow, then I think we could see US equity markets underperform.
Right. But so, Greg, what exactly are you worried about? Is it CapEx? Is it money that's not being spent? Or is it actual earnings growth?
Yeah, I think really it's earnings growth. I mean, we've come from this back of a real stellar year last year where we saw kind of 20% year-on-year earnings growth. The forecasts for this year were around 10% year-on-year, and those have come right the way back down to 6% year-on-year. And we think roughly half of that 6% year-on-year growth is contributed by buybacks. So the quality of earnings growth is looking pretty poor, and we actually think that there's kind of asymmetric risk to those forecasts. There's probably more risk on the downside from here.
Does it come off of reduced revenues or does it come off down the income statement?
Well, I think it's a combination of revenues slowing and then record margins starting to contract. So the one part of the US macro data that remains very strong is the labor market data. So we see a risk that you do see a slowing in top line growth.
A risk, do you see it now? Do you see the labor function happening now?
We do see wage growth accelerating, yeah, absolutely. That's something that we've seen pick up over the last 12 months. There's a lack of slack in the labor market. So we think even in the context of slowing growth, we could still see higher wages, and that's going to compress margins that are at record levels.